Hello everyone! I've received many questions, emails about what's going on in the market, what should we think about, how should we invest. So I said, okay, let's do another video and for this weekend and really discuss the key topics that are plaguing maybe your minds when it comes to your money and investing. I will start by discussing the stock market situation, what is the news that hits your mind, then we'll discuss the real fundamental drivers, the changes, the happenings and the thinking of the, let's say, players that make it all happen, the Fed, ECB, and how they are thinking, what's that impacting our lives. Then go to the real investing fundamentals and see how the fluctuations of two impact the valuations of three, the current negative real interest rates, etc. to conclude with an investing outlook. If you like this video, as always, support the channel by clicking that like button. And let's start with the news, and this is really insane. I typed stock market into YouTube, okay, something is live, Omicron, Ray Dalio, and then if you look at what YouTube suggests when you type in stock market into incognito mode, so different channels using the same thumbnails, so correction coming, crash, big trouble, don't count your chickens, market is crashing, so it's 80% crashing coming soon, so 71% crash coming soon, the market crash is about to go insane. So is really insane what YouTube suggests. And just to show you that this is really incognito, also there are also some, what is this, Pakistani suggestions, and that are really crazy. Imran Khan is in trouble, also crashing in Pakistan, things are really bad there. But this is survive the crash. This is what YouTube discusses. But if we look at the stock market, yesterday it went up 1.42%. In a month, okay, it's down a terrible 1.79%. I think that these kids never seen a crash if they call everything a crash, every minimum increase in volatility a crash. Okay, 4% down, but if you look at the last 6 months, the market is up 10% in 6 months. Year to date, what is this, 23%, 5 years, up 102%, and since this Google measures, we are up, what, 3,500%. Yes, crashes everywhere. It's a terrible market. However, there are some market pockets that are on shaky ground, especially because of what we'll discuss later in what the Fed does, ECB. So if you had invested in ARK last year when it was the best performing fund of all time, you would be now a little bit down 30%. Nothing tragedy. I think this, for such a strategy, is not really bad. There was really exuberance as people always follow the best performers, and then tech stocks really started to suffer a little bit, and now it's a little bit down. But still, again, if you look at 5-year performance, even that has done really well, so no crashes of significant matter, neither there. When that happened last year, I made this video about the dangers of investing in ARK, and maybe the dangers in 2021 have emerged a little bit because the situation is a little bit insane when it comes to current happenings. However, whether it is insane on the positive side or negative, we cannot know. YouTube pushes crashes, but I think that there is the same probability for the market to double in the next 5 years or to halve in the next 5 years. I really think it's impossible to know because a lot will depend on what the Fed, central bank, European Central Bank do and how they react to whatever data-driven decision-making they call themselves doing. First, the data decision-driven making is, okay, their data said that it will be all transitionary about inflation. Now their data says, oh, it's not transitionary, it will be here for longer, so we'll see what we have to do. But everything is good, yes, great, so we might start tapering a little bit earlier, maybe even make a hike or something like that. So, as said Jerome, probably a good time to retire that world when it comes to transitionary, because inflation has hit 5% in the last month and the forecasts are down, but the forecasts were never also about this, so we'll see whether forecasters will be right or not. And now the question is, how significant is this? How significant is the Fed's action? How significant is inflation? What's impacting inflation? Is it correct what the Fed says or not? Or we might all be wrong. I prefer taking a stance, I have no idea what will happen. Of course, Jerome has also no idea what will happen, but in my job, in my case, I'm independent, I can say whatever I want. However, Jerome cannot say whatever he wants because even what he says impacts the market. The fact remains that even Jerome has no idea what will happen. And now they discuss, but this is the situation. They have increased the balance sheet of the Fed 10 times in the last 12 years. 10 times in the last 12 years. But the reasons for inflation are other, of course. This is again something interesting. The real interest rate. So if you own bonds, you're losing money. You're losing 2.46% of real purchasing power per year if you own 10-year treasuries. Good luck with that. And of course, the projection is that both the Fed, the ECB, and everyone will still print money and push it into the system going forward. If this keeps happening, then the markets will also go forward. But can it be that the money printing is pushing inflation, or it is supply chain issues, it is this, it is the recovery of COVID, or it's just money printing? The Fed doesn't even mention it, but let's check. Even in OECD countries, the highest ever reached inflation over 24 years. And then to just jump away from the Fed a little bit, I went to read the last speech that Lagarde, ECB president, the European counterpart of Jerome, both have the same haircuts, said in the last speech. And then, okay, there is higher inflation, finally they recognize it, and they say even that it squeezes real incomes, something the Fed doesn't dare to say. So she's a little bit more daring in saying things. They argue that those drivers are likely to fade over the medium term, which is the horizon that matters for monetary policy. So short term and long term doesn't matter. I mean, I can't stop laughing when I listen to these people. But then, okay, because they largely stem from the supply side and energy prices, and they will probably slow the pace of the recovery in the near term. Of course, supply imbalances, energy, gas prices, and then of course this has a big impact. The fact that you don't go to the gym but you buy home equipment and you spend more, that's very important. Yes, yes, yes. And also services, etc. Conclusion: these are exceptional circumstances. It's likely to slow the pace of the recovery. Okay, this is already something different than what the Fed says, because slowing the pace of the recovery means recession, lower than expected economic growth. What will the Fed and ECB do? Print more money? Will we see more inflation? Higher? Lower? Again, impossible to predict because nobody knows what will happen in the next 6 months. And therefore, this is all, as Charlie Munger says, BS. Yes, they all went to business school, and therefore everything that they talk is pretty much BS. Always keep that in mind. And the final thought here, nobody is mentioning that they printed an unprecedented amount of money flushed it into the system over the last years, don't you remember you got money directly sent in the mail with a check? In Europe, most of you got money directly sent to you in some form. So just money out of nowhere has been sent to you. That's a great way to live. But suddenly then comes inflation, and that's because of supply chain issues. Yes, and don't forget workout machines that we are strong. But let's discuss the fundamentals of what's going on. Okay, tapering, maybe a hike there. How will that impact the market? And then, of course, how the market will again impact back the decision-making process. If we look at the S&P 500 dividend yield, it's 1.29%. So the real negative dividend yield is, let's say, minus 2%, similar to the Treasury. If I calculate things, then the in points dividend is 58.97, and then if I want to calculate to 2.29%, let's say that the dividend required by the market goes up by 1%, just one, division there to calculation 43.66, multiply with the dividend 43, and I get to a level of the S&P 500 of 2,575 points. So if the market requires a 1% yield higher, the S&P 500 goes down 45%. These are the fundamentals, and therefore, yes, of course, everything can crash, but we don't know whether it will happen, when it will happen. It's just the risk of the current market. If we go to negative interest rates, then the market can easily double, because people will say, oh, look, 1.29% dividend is much better than, I don't know, nothing or negative or zero, etc., etc. So anything can happen, and I think the likelihoods there are always normal. The market will definitely be volatile, and that's something we have to accept when it comes to investing. However, this impact of higher rates, just a little bit friction in the availability of money, impacts a lot ninja stocks, no income, no revenues, actions or stocks or whatever. The thing is that if you are a business that doesn't make any money, that constantly needs new capital to grow, to keep the business going, and there are thousands of businesses like that today in the market, a lot of leverage, also equity leverage. Getting new equity is practically similar to getting debt, and all those are very, very sensitive to what's going on. If there are more frictions in the available liquidity, where the market now is flushed with liquidity, then all these businesses, if they don't get their injection of cash on a monthly basis, then everything becomes very difficult, or at least differently valued. That's why you see a lot of drops with the tech stocks, 50% down, 40% down, as we have seen with ARK. And also, it is a factor of price. This is the standard Fama and French analysis over the market. And growth, of course, growth stocks in their way, so this is all superficial, but okay, growth stocks have really done well since we have had zero interest rates and free money, compared to value in this case. But value still did okay in the last years. But over the last century, look at the outperformance of value. So when it comes to investing, always thinking, okay, what will do good no matter what? What will do good no matter the exceptional zero interest rates flushed with money market that we are living now? And that's exactly what I'm thinking when it comes to investing outlooks. I am sure that whenever it comes to markets, we have to understand that we are, as always, really living in unpredictable times. Nobody can have an idea about what will happen in the next 2 years. It is absolutely impossible. Go back 2 years and seek for someone saying what has happened exactly. That's impossible. So again, it's impossible to know what will happen next. So why don't we have a strategy that is ready for the most unpredictable things? Okay, this works, of course. It might not be the best strategy. Perhaps growth stocks will explode again next year, but chasing those strategies is really not value investing. Value investing is first thinking, risk, okay, if this goes wrong, if everything goes wrong, do I come out better off? If yes, that's value investing strategy. Therefore, I like it, because what's the alternative? And value investing is on focusing on real returns, something that whatever happens in the nominal world of money, of interest rates, of whatever, that it makes money if interest rates go up, if interest rates go down, and develops, grows as a business, creates value no matter what, that it really creates real returns. That's my first focus, because here you're definitely losing money. And in this environment, I just finished analyzing the Dutch stock market, and we'll make the next video about, let's try to find 5 businesses on the 100 something that I analyzed that might beat the Dutch stock market. So that will be, let's say, the next video when I make it, and it will be a very interesting perspective on current investments. And on uncertainty, just watch the recent Ray Dalio video. We'll put the link in the description below. It's just 49 seconds. How the world will be totally different than it is now. This is really, really important to understand and simply accept. And then when it comes to investing concepts, creation of value no matter what, you can think of hedges. We'll discuss that in a moment. And always keep in mind what investing is. Let's discuss this. Creation of value no matter what. This, if you rent out a house, you get your rent, and that's it. In 10 years, 1 year will be vacant, but most of the times you will be able to collect rent, and that will create value no matter what, especially if it's a good property. I'm just trying to simplify investing here. What kind of return also depends on the price you pay. So the first indicator of risk when it comes to investing is, of course, price. And that's why also the market is that sensitive, especially on these low interest rates. Then you can think of hedges, and if you look at the S&P 500 option chain, if you want to be protected for whatever, then in a year, this is for December 22, it costs you about 8% of your portfolio to absolutely protect yourself from downside. Of course, if you say I want to be protected for 20% drop and then be protected, then it is already cheaper. What is that? 5% for a year, and lower it's already cheaper. So if you really want absolute protection, absolute security, you can simply buy puts on your portfolio, renounce 4, 5, 6, 7% of your portfolio per year. But if the market goes nowhere, then it is an extremely costly strategy to hold on for more than a year or two. But if you have any short term, then you might say, okay, if the Fed prints more money and this doubles, I am at least doing a better return from a risk perspective. And you have to see how this fits you from a hedge perspective. But when it comes to investing, I prefer this. This is of a certain guy returns, and from 69 to 75 the returns were absolutely zero. So 1, 2, 3, 4, 5, 6, 7 years of investing, and returns, when you calculate this up, were below zero. So that's something we have to accept, because if Warren Buffett had zero returns for 7 long years, why do we think we could do better? And despite the zero returns in 75, it turned out to be the best investment ever, despite the 7 years, the 7 bad years. So, as in the Bible, always expect 7 bad years after 7 great years. That's the key investing concept that prepares you for all the uncertainty ahead. So it's always easy to invest when things are great, when things go up, but again, accept different times. If we look at the S&P 500, of course, since interest rates started to go down, then of course assets went up. But also there are periods from 2000 to 2012 of absolutely nothing, but those that accumulated real assets wealth here did really well. And then we have an explosion here, as Buffett said, as Buffett did. Those that accumulated here in the 70s did really well. Exuberant 60s, no recessions, not even COVID made a recession. There will be a recession, as also Lagarde said a little bit about that, but of course Powell is not allowed to say that. So just see what you need in your life, how the assets you own are positioning you for whatever might happen in your life, and we'll discuss in the next video more into details on just those slight details with value and risk to compare how can we limit our risks by owning businesses and then leave the volatility to whatever happens in the future. If you want to see my portfolio, my hedges, please check my research platform before the end of the year to lock in the price. Thanks, and I'll see you in the next video.